What's the difference between mutual funds, index funds, and ETFs? This is a super common question and a totally fair question because it's a little bit confusing, so I'm going to break it down in this video. I share a lot of great money and investing educational videos on my channel, so be sure to hit that subscribe button. Let's get started. Mutual funds have been around for a long time, and they were originally created as a way for investors to pool their money to invest in various securities, stocks, bonds, etc. Nowadays, anyone can buy a mutual fund through a brokerage account, through their 401k, or through other investment vehicles that they own. There are a lot of benefits to mutual funds. The first one being they're easy. Instead of going out and buying a bunch of different stocks, you can buy one mutual fund that holds dozens of different stocks, giving you immediate diversification and ways to get into a lot of investments with one fund. Now, some mutual funds are more diversified than others. Some focus on a specific type of stock or a specific size of a company stock. But all in all, what you're getting is a bunch of stocks with one fund. Depending on the mutual fund you choose, they might be US stocks, international stocks, emerging market stocks. It could be a variety of different types of investments in that one mutual fund. There are some considerations you want to understand before you purchase mutual funds. So for starters, mutual funds that aren't index funds are typically actively managed. What that means is a fund manager is actively selecting different stocks to put into that fund that you're going to buy. Theoretically, this sounds great because you're having financial professionals or fund managers select a bunch of different stocks strategically to put it into a fund. So you'd expect that the performance might be better than other types of funds. The reality is that building a mutual fund portfolio that will beat the market is a really hard thing to do. And when we say beat the market, typically what we mean is any of the major indexes that are built to measure the performance of a stock market on a whole. So for example, the S&P 500 is the top 500 largest companies by market cap in the US, and that is one way to measure the performance of the market. What I'm saying is the majority of actively managed funds don't beat the market, and there's a type of fund you can buy that actually just invests in the market as a whole. So that's one reason why actively managed mutual funds might not be the best option for you. Now, even if you manage to find a fund manager or a mutual fund that's outperformed the market over the last few years, it's impossible to know whether that performance will continue into the future. The other challenge with mutual funds is typically because they're actively managed, because a fund manager is selecting specific investments to put into that fund, typically they cost more. Every fund has a cost associated with it, and this is called an expense ratio. An expense ratio is basically the operating cost of the fund. So if you're investing in a mutual fund that's actively managed, you're going to pay more for that fund, and it might not perform better than a passively managed fund. The other challenge is that these fund managers get paid whether or not the fund goes up or down in value. So if you had $10,000 invested in a fund that cost 1%, you're going to pay $100 to that fund manager regardless of whether the mutual fund's value increased or not. So to recap, a mutual fund is just a fund that holds a bunch of different stocks. Now there's another type of fund called an index fund that is a type of mutual fund, but is a really great way to start investing. In the 1970s, a guy named John Bogle totally revolutionized the investing industry and found a way to create funds that were way less expensive than mutual funds, had lower fees, and were great for the average investor. Some people even call him Saint Nick because it was such a win for people wanting to invest in the market but not wanting to spend a ton of money on fees. All right, so what's an index fund? Well, let's start with what an index is. An index is just a list of stocks typically used to benchmark against a specific outcome. So for example, there's indexes that track the top 500 largest companies. There are indexes that track the top 30 companies in technology. All of these are just lists or groups of stocks. That's what an index is, and typically it's measuring the performance of the market or a part of the market. An index fund is just a fund that invests in that particular list of stocks. So because an index fund isn't actively managed and it's just trying to mirror the performance of a specific index or a specific list of stocks, it's way cheaper to own. And over the last few decades, these passive funds, these index funds, have performed better than most actively managed funds. So if you can buy a fund that performs better and costs less, that makes a lot of sense to get into. Just to give you an idea of the difference in expense ratios, some mutual funds can cost over 1% to own. That means over 1% of whatever you have invested in that in that fund is going to be taken out of your account. Index funds, on the other hand, have low expense ratios. I'm talking about 0.03, 0.04%, super small overall percentage of what you're investing and what your return might be. So to tell the difference between mutual funds and index funds, typically you can look at information regarding the fund, and if it's an index fund, usually it'll say index in the actual title of the fund itself, but it'll also say something like, the purpose of this fund is to track this specific index. The description for a mutual fund, on the other hand, will say something like, the stocks in this mutual fund are selected specifically for XYZ reason. If they're actively selected for a specific purpose and it's not just trying to mirror an index or a list, that's going to be an actively managed fund and that's likely going to cost more. All right, so where do ETFs fit into the mix here? ETFs are just exchange traded funds. In some ways, they're very similar to index funds, and sometimes you'll hear these terms used interchangeably, but they're not actually the same thing. The major difference is how they're traded. An ETF can be traded in the stock market throughout the day, whereas an index fund can only be traded once a day. Most people don't need the ETF version of an index fund. The only reason you would need that is if you want to trade in and out of the market very quickly, and if you're buying index funds, you're likely prescribing to a passive investment strategy, which likely means you're buying a couple index funds and you're holding them for a very long time. This is a buy and hold strategy, and typically this works really well for people. People that buy and hold their investments for a long time typically outperform people that try to day trade or trading in and out of the market because it's impossible to time the market. So that's really the only difference between ETF index funds and regular index funds. So it doesn't really matter. I just have regular index funds because I have no intention of trading them very fast on a regular basis. So to recap, a mutual fund is just a fund full of a lot of different stocks. There's lots of different type of mutual funds. They can have different objectives. Index funds are technically a type of mutual fund, but index funds specifically are not actively managed, meaning they track or attempt to mirror a specific index and to mirror the performance of that index or list of stocks. And an ETF can be an index fund or a mutual fund, but an ETF just means it's an exchange traded fund and it can be traded throughout the day, typically not necessary for most passive investors. That's a wrap. If you have any more questions, feel free to drop them in the comments and subscribe to my channel for more investing and money education.